Good morning, everyone. Welcome to this update for global stocks and commodities for the 21st of October. Last week was a lot quieter than the week before when the US market just all of a sudden fell apart and there was very, very heavy selling in the latter half of the week. But on a scale of 1 to 10, it was still pretty volatile. There was still some bigger range days in both directions. And what we're seeing very, very clearly is that there is some significant selling, particularly in the large technology stocks, the FANG stocks, Facebook, Amazon, Google, etc. And that really shows some very interesting patterns. So I want to get into that. And of course, whenever that happens, whenever parts of the market that have been the leading sectors suddenly sell off and sell off with a fair amount of enthusiasm, then that money has to go somewhere else. And of course, the outlook is still pretty strong, so the money's not really coming out of the market. It's just rotating into different areas of the market. And so there's always opportunities, no matter how grim things look. So in this update, I just want to have a look at is there more selling to come? The answer is almost certainly yes. So therefore, how much? And where will the smart money go when when the dust settles in a few days or a few weeks? So that's the key, is to always be looking for opportunities. We'll look at the general stock and commodity trends last week in Portfolio Analyst following that big upheaval in the States. I looked at market tactics and opportunities, and that was a very well-received session. I've had some really good feedback, so thank you to those people. Okay, so let's just start with a technical perspective first of all. From a fundamental and valuation point of view, and also from a technical point of view, the bull market is not over. So let's get that one out on the table. And one of the key reasons from a fundamental point of view, and I've just done this to death over the years, while people have been trying to call market tops since around 2015, is that none of the precursors are in place. And I'm not going to highlight them again. I've done it so many times, but none of the precursors are even on the horizon at this point in time, and there's 4 or 5 of them, and they take time to build because they're big picture shifts in things that just take a long time to evolve. So that's why I don't think we're within 12 months or possibly even 2 or 3 years of a major market top. The S&P index, have we seen the lows, or is there more to come? Well, as you'll see from the chart, almost certainly more to come. But the nature of how that's going to play out is just too early to say. We just don't have enough information at this stage. And I'll explain what it is that I'm looking for. But so far, it's pretty clear that there's a lot of selling. There's more selling coming out on the down days than on the up days. And the indices, generally look pretty weak. The character and the candles and the volume are what I'm looking for. Now, I don't have enough information at this stage to be definitive, but that's what I'm studying rather than just where the price of the index is. I mean, that's a very superficial way of looking at it. It's how it looks on the down days as against the up days, and we're looking for the end of the selling. Corrections are about a burst of selling. You get most of the selling occurs in the early and middle stages, and then towards the end the selling dries up, and then the market is in a position to move higher, and that's what I'm looking for. From a technical point of view, the prior market leaders, which is technology and particularly FANG stocks, have broken down very badly, and you don't really get an understanding of how badly that breakdown has been until you can look at a composite of those stocks. And I've found an ETF that does provide that composite look. And there's been a very significant change in character, not only from the last 3 or 4 months, but also compared to what happened around the big buying climax that occurred in January of this year. So there's a very, very clear and significant change of character there. So then my mind immediately goes to what will take over the leadership, at least for an interim period, because technology will return. The position of stocks like Apple and Amazon and Netflix and Google, etc., is massive. So technology is not going away, but there's certainly a big change of character. Okay, so let's jump in. Well, first of all, I'll just cover this slide first. So the S&P was flat across the week. We went down, we went up, we went back down again. There was significant volatility in both directions. Now, reporting season has started really well, and it's right on track. We've seen 19% earnings gain so far, which was pretty much what the market was expecting. We've seen 7 of the 11 main sectors reporting double-digit growth in earnings, so that's spot on, and all 11 sectors are reporting growth. So 7 of the 11 double-digit growth, and the other 4 sectors are single-digit growth. The leaders in terms of earnings growth, finance, what we've seen so far, that 6 of the 7 major banks have not only shown very good growth, but have also beaten expectations. There's only Wells Fargo that was behind on beating expectations. And we've also got energy and materials, but bear in mind they're coming off a fairly low base. So it's not surprising that energy and materials would be reporting and expecting double-digit growth. But for me, it's finance that is not coming off a low base. They had good expectations, and they're beating those expectations. Now, the share prices of the finance sector has not done anything marvellous. In fact, they've been lagging. So I think that's a sector that's yet to come into its own. The US dollar was slightly higher on the week. Not a lot of change there. So let's jump in and look at some key charts. All right, we'll start with the S&P. And you can see this was last week, the week before last, I beg your pardon, the big decline on Wednesday, big follow through on Thursday, and then we've just sort of bounced around since then. Now, I'm expecting, and this will have more relevance, why I'm expecting a lower low from the next chart that we look at. But there's a number of ways to look at this, but I just basically put a Fibonacci retracement on this and look at a retracement of the run that we had from the lows formed in February to the recent highs that we formed. And we've already smashed through the 38.2, which indicates strong selling. We've gone to just a tick below the 50. And I believe that somewhere between the 50 and the 61.8% retracement levels is what you would normally expect when there's a strong sell-off underway. Now we've just had a small decrease into that range, and because of the next chart, I think that we will go down and probably give the 61.8% a bit of a run as well. Now that chart really so this is an ETF. The code is FDN, and that is a structured ETF. It's not one that's just put together by the 40 biggest stocks. So this is one where a manager, an ETF manager, actually selects the stocks according to a theme, and they hold the 40 biggest US internet companies that obviously include Amazon, Facebook, Google, Netflix, Salesforce, PayPal, and eBay, amongst others. And what I want to highlight is the two areas. So this area here is the buying climax that occurred in the market in January. Now, look at the reaction in January. It was very mild. It was much milder than the general market, and then went on to not only quickly set new highs, but to go a lot further than the S&P did. And look at the volume of the selling. It was very modest. But look at what's happened this time. The selling, and we've now got a significant breakdown of the lows. We've now gone into a very significant sideways band that is now broken down. So, quite clearly there was institutional selling up here that has now led months later into a complete breakdown of this index. And look at how much the volumes have risen here. This is substantial. A big rise in the volumes have occurred in the last few weeks, and you can see that it's been underperforming the S&P index since late July. So clearly the institutions have been selling these big technology names that had led the market higher. And because of this breakdown, and you look at the nature of the candles, look how big this candle was last Wednesday, look at the volume behind it. We had a weak rally. The volume on the rally was weak. And now, as soon as the selling kicked in again on Thursday and Friday, the volumes have picked up again. So this almost certainly has further to go. And so I'm looking at these two potential support levels here. So we've broken down from around 146. We're currently sitting at 127. And I'm looking at possible support levels at 115 and around 110. So I still think we've got some more selling in the major stocks. That is going to impact sentiment, and so therefore I would expect that the S&P is probably going to form new lows. So let's just look a little bit more at this breakdown. So this was reached a bit of a buying climax in June. We had some selling. We then went and formed a new high. We had a breakout, but then that breakout immediately, and that breakout occurred at the almost at the end of this climax here occurred almost at the end of the quarter. We then got a breakout in late July, and then look at the breakdown, the initial selling, and again, it's not that easy to see, but there's definitely a big rise in volume here. The volume doubled on these 2 days of selling on the 27th and 30th of July. And then since then, we've formed a series of lower highs, and now we've got a breakdown of support, and we're getting lower lows. So that's a very telling chart, that one, and it's one that I'm going to be watching very closely. Because while that keeps selling enthusiastically, it is going to impact sentiment, and that's going to have an impact across the whole market. Now, the other thing I want to look at then is, well, where is the money going to? And so I just want to take, now this is a very busy chart. I apologise for that, but hopefully you'll understand the point that I'm making, and I'm going to be exploring this in a lot more detail in Portfolio Analyst this week, and watching it very closely over coming months. So what this is showing is the various sectors of interest coming off a common base 12 months ago. So this is FDN. So on a 1 year view, it's still leading, but it's dropping very quickly. So we've got, I'll just run down the list. So we've got basically the big technology internet stocks. Then we've got XLY, which is healthcare. And then we drop down, and there's not a big difference amongst a lot of these. So we've got ITA, which is aerospace and defence, XLV, which is healthcare. We've got the S&P 500. We've got the energy sector. We've got transports. We've got XLP, which is consumer staples, and you can see how much consumer staples have kicked up in the last couple of weeks. So that's people going defensive. And then we've got XLF, which is banking, still struggling a bit, and then at the bottom we've got semiconductors. So that's on a 1 year view. Now let's zero in and take a look at how this looks over the last quarter. Now, quite a different story over the last quarter. Healthcare is now clearly the leader over the last quarter. XLP, staples, consumer staples have kicked up. Aerospace and defence has done reasonably well, and there's the S&P. So aerospace and defence, consumer staples and healthcare have all beaten the S&P. And of course, all these others have underperformed, and you can see in the last month, semiconductors and the big technology stocks have clearly been absolutely belted in the last quarter. Now let's come in a little bit closer and see where the money might be going. in the last, let's say in the last fortnight since the sell-off started. Now, this is a very exaggerated scale, so we've got to take this with a bit of a grain of salt. But consumer staples, no surprises there. The money's swung into the defensive sectors of the market. Healthcare has still done relatively much better, and it's outperforming the S&P in the last 2 weeks. So that's what I look for. What are the sectors that have done better than the general market? So clearly, healthcare and consumer staples. You can see FDN is absolutely falling off a cliff, and then all the others line up here. And energy, of course, has been impacted in the last couple of weeks with the oil price having come down. So that's how the market looks on a rotational basis, where the money's going. Now, the US dollar was up on the week. But you can see it's just basically bouncing up and down at the moment. And the impact that had on the Australian dollar rose very slightly, but it was essentially flat across the week. While I'm here, I'll just look at the ASX 200, and we did make a gain of around 40 odd points on the week, and you can see that was a decent bounce towards the end, and most of that was due to the banks, which rose over the last 4 sessions. So the Australian dollar up slightly, our index gained 44, and that was mostly in the banks. Now, precious metals, gold rose by $8 to $12.27, and we may now be seeing a new uptrend emerging from an 8-week base. And precious metal stocks, we had a big spike in GDX last week, and now we're seeing some useful follow through in the last 7 days as well. So let's take a look at that. So here's the gold chart on a weekly basis. Here's this consolidation around the support that we would have expected to see consolidation, these prior lows here. And now you can see we've had 2 pretty good weeks. There's a lot of things coming together for precious metals at the moment, and I'm getting more positive on precious metals. Cautious, but a little bit more positive. And this is GDX, so a big spike last week, and some managed to hold the gains and a bit of useful follow through as well. And going to be covering this in Portfolio Analyst. Aussie gold producers have been rising, of course, and have been rising for quite a few months. So a much better scene there, but I've been pointing that out consistently now for some time. But we're also seeing a few green shoots in the share prices of the global majors as well. Now, turning to other commodities, copper was down about 5 cents, but you've got to remember, whilst copper has been weak over the last 3 or 4 months, I'll just give you a reminder of where the copper price ultimately has to go, because when you look at the inventory trends, unless global demand is just suddenly going to fall off a cliff, then we've got to see some more positive trends in copper price. The crude oil fell to 69.37, and that finally the weight of just 5 successive weeks of rising inventories have taken their toll. And so, that was always going to happen. But look, this is really just a normal pullback after a rally, so there's nothing really untoward there at all. So let's take a look at that chart. Sorry, skip to the right chart. So there is the 6-month copper chart. So not a lot of change there recently, but this is the inventory chart that I wanted to show you. So there's the 5-year chart, and I showed this a few weeks ago. So you can see now that we're basically back down to the lows that were formed in April to September of 2014. And then again in February, March of 2016. And of course, what happened after that was that the copper prices picked up quite strongly. So we're back down to those levels again now. And let's just zero in to make sure that there hasn't been a turn up already. And you can see that the trend is still as strongly down as ever. That's on the 6-month chart. So this has eventually got to have an impact on copper prices. And there's the 3-month crude oil inventory chart. So you can see over the last couple of weeks we have come off from around 72 down to 69. So eventually those inventory build up in oil stocks in America have taken their toll. So wrapping it all up, there's no question we've got a changing landscape. You can't look at that chart of FDN, the major technology stocks, and draw any other conclusion. So we are getting a shift, and we're also getting a shift away from higher PE stocks as well. So it dictates a bit of a shift in methodology, not a radical change, but certainly a shift. And so I'm seeking opportunities where the risks are far lower, but we can still access strong growth. And I've done that in some detail over the last 2 weeks in Portfolio Analyst, and that will be continuing. Now, there are 2 types of opportunities where that combination occurs, and I detailed both of those last week and gave plenty of examples of stocks that fitted into that category in the Australian scene. So if you've not been a part of Portfolio Analyst yet, I think the information in the last 2 weeks' editions has been invaluable in my view. Portfolio Analyst this week, I am going to be looking at precious metals as well as continuing to present information on where those lower risk but strong growth opportunities exist. So there's my contact details for anyone that wants to communicate with me that's not a member of any of the services that I provide. And I will be back with you next week. Cheers.